Hello everyone, welcome to the market opening bell on Thursday, May 29th. Hong Kong stocks were volatile and soft on Wednesday. The Hang Seng Index opened 3 points higher, briefly rose 94 points to 23,476, then fell back in the afternoon. It dropped 201 points to 23,180, closing down 123 points or 0.5% at 23,258. The A-share index fell 26 points or 0.3% to 8,443, and the Hang Seng Tech Index dipped 7 points or 0.2% to 5,174. Total market turnover was 180.8 billion Hong Kong dollars. Southbound trading saw a net inflow of 3.578 billion Hong Kong dollars, down 70% from the previous day's 11.975 billion Hong Kong dollars. Technical analysis: the Hang Seng Index closed below its 10-day moving average for the third consecutive day, likely to fall below the 20-day moving average at 23,200, with the next support level at 23,000. Shanghai and Shenzhen markets opened high but closed lower. The Shanghai Composite Index fell 1 point to 3,339, and the Shenzhen Component Index dropped 26 points or 0.3% to 10,003. Combined turnover was 1.0099 trillion yuan, up 11 billion yuan from the previous day. The renminbi central parity rate fell for 2 days to 7.1894 against the US dollar, down 18 pips. Onshore and offshore renminbi prices fluctuated around 7.19. Back to the Hong Kong market, auto stocks weakened. BYD fell 11.2 Hong Kong dollars or 2.7% to $407, and Geely Auto dropped 0.42 Hong Kong dollars or 2.3% to $17.64. Cui Dongshu, Secretary General of the China Passenger Car Association, noted that under the auto trade-in subsidy policy, auto production in the first 4 months of 2025 reached 10.12 million vehicles, up 11% year-on-year. Industry revenue was 3.26 trillion yuan, up 7%, but costs rose 8% to 2.86 trillion yuan, and profits fell 5.1% to 132.6 billion yuan, with a profit margin of 4.1% compared to the downstream industrial average of 5.6%. In April, revenue was 853 billion yuan, up 5%. Costs were 751.7 billion yuan, up 6%, and profits were 37.9 billion yuan, down 2.2%, with a profit margin of 4.4%. The auto industry needs cost control to improve efficiency. Xpeng Motors chairman He Xiaopeng at the Xpeng Honor M03 Max launch commented on the price war, stating the current competition in the auto market is not intense. It will peak in one of the next 5 years. Company earnings: Kingsoft reported Q1 results ending March 2025 with revenue of 2.338 billion yuan, up 9.4% but below the expected 2.49 billion yuan. Office software and services revenue was 1.302 billion yuan, up 6% year-on-year and down 13% quarter-on-quarter, accounting for 56% of total revenue. Gaming and other businesses revenue was 1.037 billion yuan, up 14% year-on-year but down 20% quarter-on-quarter, making up 44% of total revenue. Net profit was 284 million yuan, down 0.2% year-on-year and 38.3% Q-on-Q. Gross margin was 82%, up 1 percentage point year-on-year but down 2 points quarter-on-quarter. Chairman Lei Jin said Kingsoft office will focus on AI, collaboration and internationalization, maintaining R&D investment to deliver practical office products. The gaming business will deepen flagship IP operations and target new genres like anime and sci-fi. Scientific companies reporting today include CSPC Pharmaceutical, Li Auto, and U.S. firms Dell, Costco, Best Buy, Gap, and Futu Holdings. In the U.S. market, the Federal Reserve's latest minutes showed concerns about tariffs raising inflation and unemployment. The 30-year U.S. Treasury yield hit 5% during trading U.S. stocks fell late, with the Dow closing down 244 points or 0.6% at 42,098. Nasdaq down 98 points or 0.5% at 19,100, and S&P 500 down 32 points or 0.6% at 5,888. The Nasdaq Golden Dragon China Index fell 0.7%, Alibaba dropped 2.3%, Pinduoduo fell nearly 5% to 97.87 US dollars, breaking below 100 US dollar. Major tech stocks like Tesla down 1.65%, Microsoft down 0.7%, Amazon down 0.6%, and Nvidia down 0.5%, while Apple edged up 0.1%. After the close, Nvidia reported Q1 results ending April 27th, 2025, with revenue of 44.06 billion US dollars, up 69% year-on-year and 12% quarter-on-quarter, beating expectations of 43.31 billion US dollars. Data center sales rose 73% year-on-year to 39.1 billion US dollars, up 10% quarter-on-quarter. Net profit increased 26% year-on-year to 18.8 billion US dollars, with adjusted earning per share of 0.96 US dollars, likely above the expected 0.93 US dollars. Non-GAAP gross margin was 61% or 71.3% excluding China-related H20 chip inventory costs. Nvidia's stock rose nearly 6% after hours. CEO Jensen Huang noted strong global demand for Nvidia's AI infrastructure. Nvidia forecast Q2 sales of 45 billion US dollars, below the expected 45.9 billion US dollars, citing an 8 billion US dollars sales loss from China H20 chip export restrictions. On economic data, the U.S. Richmond Manufacturing Index for May improved to -9 from -13, beating expectations of -10. Our stock pick today is J&T Global Express, stock code 1519. J&T Global Express primarily provides express delivery and cross-border logistics services, with its express business spanning 13 countries, including 7 Southeast Asian countries: Indonesia, Vietnam, Malaysia, the Philippines, Thailand, Cambodia, and Singapore. China and 5 new market countries: Saudi Arabia, UAE, Mexico, Brazil, and Egypt. In Southeast Asia, based on parcel volume, the group has been the top-ranked express operator since 2020, with a market share of 28.6% in 2024. Since entering the Chinese market in 2020, the group has continuously learned advanced industry knowledge and management experience from China's express industry, systematically applying these to Southeast Asia, consistently reducing per-ticket costs. A 14.9% year-on-year decline in Southeast Asia's per-ticket costs in 2024 demonstrates the effectiveness of this strategy. In China, based on parcel volume handled in 2024, the group holds an 11.3% market share, ranking 6th among express operators. The group has strengthened its express network in rural areas, significantly improving village coverage and leading the industry. Through various agricultural support projects, it addresses the challenges of sending agricultural products from rural areas, facilitating the market access. The group also collaborates with multiple e-commerce platforms to handle consolidated shipping for remote areas, significantly reducing shipping costs, overcoming the historical no free shipping issue for remote regions, and gradually expanding the coverage of consolidated shipping services. In new markets based on 224 parcel volume, the group holds a 6.1% market share. It has established close partnerships with international cross-border e-commerce and short video live streaming platforms such as Shein, Temu, TikTok, Shopee, AliExpress, and Kwai, leveraging extensive geographical coverage and robust infrastructure to address logistics challenges for these platforms. It also emphasizes cooperation with local e-commerce platforms such as Noon in the Middle East and Salah in Saudi Arabia. Looking ahead with improving macroeconomic conditions and a booming e-commerce retail market, demand in the Southeast Asian express market continues to grow. To promote sustainable development in the Southeast Asian express industry, several Southeast Asian governments have issued policies and guidelines in relevant regions to clarify definitions and strategic directions, provide infrastructure support, and facilitate orderly industry growth. In China, rural market sales and income growth continue to outpace urban areas, with significant potential for future growth in lower tier markets. To promote the healthy and orderly development of the express industry and create a favorable business environment, the Chinese government has introduced multiple policies and reform measures in new markets driven by growth in the social retail market and the rapid development of e-commerce retail. The express industry has seen significant growth. According to Frost and Sullivan, the total parcel volume in new markets reached 4.59 billion in 2024, up 18.6% year on year, and is expected to grow at a compound annual growth rate of 17.4% from 225, reaching 10.2 billion parcels by 229. Recommended buy price 6.7 Hong Kong dollars, target price 7.35 dollars, stop loss $6.35. I do not hold the above stock.